In this video, we will cover the essential concepts and tools of accounting that every small business owner should know. Whether you are just starting or have been running your business for some time, this guide will help you understand the basics of accounting and how it can benefit your business. Hello and welcome to my channel. My name is Bob Muhammad. As a small business owner, understanding the basics of accounting is crucial for your business success. One of the reasons is that accounting involves keeping track of the money coming into and going out of your business. This includes recording your daily business activities such as income, expenses, assets, liabilities, and equity. By doing so, you can determine your net income or loss, cash flow, and overall financial position. It enables you to make informed decisions about your operations, investments, and growth strategies. Having a good grasp of accounting will also help you meet your legal and tax obligations, such as filing accurate tax returns and complying with financial regulations. In addition, proper accounting practices can help you identify potential areas of fraud or financial mismanagement and take corrective actions. What is the need for accounting? Accounting is an essential aspect of running a business, regardless of its size. Accounting helps small business owners keep track of their finances, including income, expenses, and profits or losses. It allows them to make informed decisions about their business and plan for the future. We can all admit that the main aim of a business is to earn profit from business activities. But, how can the owner know the exact profit earned by him or the loss suffered by him? It is possible only if he keeps the proper records of his business transactions. A business makes so many transactions like the sale of goods, purchase of assets for official use, payment of business expenditures, deposits in banks, withdrawal from banks, payment to creditors, receiving payment from debtors, etc. It is very difficult to remember the exact amount and date of each of these transactions unless we note it down somewhere. To solve this problem, the proper accounts must be maintained. That is why the accounting system is used to maintain records for all types of businesses, from single-person businesses to large multinational corporations. Thus, accounting is a system in which financial transactions are recorded in monetary terms in such a manner that the concerned person may be able to know the actual financial position of business activities at any point in time. Now let us look at some reasons why accounting is important for small business owners. 1. Financial management. Accounting helps small business owners manage their finances effectively. They can track cash flow, monitor expenses, and identify areas where they can cut costs to increase profits. 2. Tax compliance. Small business owners need to comply with tax laws and regulations. Accounting ensures that they keep accurate records of their income and expenses, which can be used to prepare tax returns and avoid penalties. 3. Business planning. Accounting provides small business owners with the information they need to make informed decisions about their business. They can use financial statements to plan for the future and identify opportunities for growth. 4. Investor confidence. Small business owners may need to raise funds from investors or lenders. Accurate accounting records can increase investor confidence and make it easier to secure financing. Overall, accounting is essential for small business owners to manage their finances effectively, comply with tax laws, plan for the future, and attract investors. Well, no matter who you are, if you don't understand the basic accounting concepts, then you're going to have a tough time with the accounting subject. The basic accounting concepts I'm going to talk about are probably quite different from some of the other accounting websites and textbooks you've come across. When I'm talking about basic accounting concepts, I'm not talking about the official list of accounting principles from Generally Accepted Accounting Practice, GAAP, or the International Financial Reporting Standards, IFRS, etc. Those principles are nice, but they are theoretical and don't form the backbone of how to actually do accounting. When I'm talking about the basic accounting concepts, I'm talking about the fundamentals of the subject, which will enable you to really understand accounting and actually put this subject into action. I'm talking about the fundamentals. The basic stuff. The stuff you really need to know to practice as a non-accountant is how transactions are being analyzed and recorded correctly, and finally how financial reports are being prepared. One of the best things you can do when starting to study a subject is to define the subject itself as well as its keywords. By doing so, you start to get orientated and you begin to learn what the subject is all about, what its purpose is, what it deals with, and so on. Okay, so let's define accounting. In the simplest terms, accounting is the language of business. It provides information about a business that is used by managers, investors, creditors, and other stakeholders to help them make business decisions. But how do we get this information in the first place? This is by following the process, the so-called system, of recording, classifying, and summarizing financial data into meaningful formats that can be used to make business decisions. Therefore, the information that is collected and recorded is primarily numerical. This information is then presented in specific formats to various people to help them make business decisions. Now, let's try to understand some related terms used here. Financial data versus financial transactions. Financial data refers to any numerical or non-numerical information related to a business's financial transactions, while financial transactions refer to specific events or activities that affect the financial position of a business. Financial data includes things like balances, journal entries, and other financial information recorded in a business's accounting system. This data can be used to create financial reports and analyze a business's financial performance. Such as customer satisfaction ratings or employee turnover rates are non-financial information that is relevant to a business's financial performance. On the other hand, financial transactions refer to specific events that impact a business's financial position, such as purchases or sales of assets, the receipt of payments from customers, or the payment of expenses. These transactions are recorded in a business's accounting system and can be used to generate financial data. In summary, accounting deals with recording information about a business, which is mainly numerical and helps different people make decisions relating to that business. Financial data refers to information related to a business's financial performance, while financial transactions refer to the specific events or activities that impact a business's financial position. We therefore use the accounting system to maintain records for all types of businesses, from single-person businesses to large multinational corporations. I hope now you can define accounting, and we are going to define other key terms and try to understand a bit more about what we're dealing with here. We'll continue to define more key accounting terms as we move along. Types of accounting. Accounting can be divided into two broad categories: financial accounting and managerial or management accounting. 1. Financial accounting. Financial accounting is the record-keeping leading to the preparation of annual financial statements. This type of accounting deals with the preparation of financial statements, such as balance sheets, income statements, and cash flow statements. It provides an overview of a company's financial performance. The purpose of financial accounting is to provide information to external users, such as investors, creditors, and regulators. 2. Managerial accounting. Management accounting also involves record-keeping and preparation of reports, showing things like the financial position and performance of the business, but these reports are intended just for internal personnel, executives, and managers, and cover a shorter time period, like a month or quarter. This type of accounting focuses on providing information to internal users, such as managers, to help them make business decisions. Managerial accounting includes budgeting and planning, cost analysis, and performance evaluation, whereas financial accounting simply provides historical reports. In addition to financial and managerial accounting, there are several other specialized areas of accounting, including tax accounting, auditing, cost accounting, forensic accounting, and governmental accounting, among others. These areas of accounting require specialized skills and knowledge and serve different purposes in helping businesses and other organizations achieve their goals. 3. Tax accounting. This type of accounting deals with tax-related matters, including tax planning, preparation of tax returns, and representation before tax authorities. 4. Auditing. Auditing involves the examination and evaluation of financial records to ensure that they are accurate and comply with accounting standards and regulations. 5. Forensic accounting. This type of accounting involves the use of accounting and investigative skills to detect and prevent fraud, embezzlement, and other financial crimes. 6. Cost accounting. Cost accounting focuses on determining the cost of producing goods or services, including direct and indirect costs. It helps businesses make pricing decisions and manage costs. 7. Governmental accounting. This type of accounting is used by government entities, such as federal, state, and local governments, to record and report financial transactions and to ensure compliance with legal and regulatory requirements. In this course, we'll be dealing mostly with financial accounting. What is the meaning of to account for something? To account for something means to keep a record of a specific item or transaction in your business by using the accounting system. The accounting cycle refers to the process of recording, classifying, and summarizing financial transactions of a business in order to prepare financial statements for a specific period, such as a month or a year. The cycle typically includes the following steps: recording transactions. All business transactions are recorded in the general journal, which includes the date, description, and amount of the transaction. Posting to the ledger. The information from the journal entries is transferred to the general ledger, which contains all the accounts used by the business to record financial transactions. Adjusting entries. At the end of an accounting period, adjusting entries are made to reflect any accrued expenses or revenues, prepaid expenses or revenues, or other adjustments needed to accurately reflect the financial position of the business. Financial statements, based on the information in the general ledger and adjusted trial balance. Financial statements such as the income statement, balance sheet, and statement of cash flows are prepared. Closing entries. Once the financial statements have been prepared, closing entries are made to reset the balances in revenue, expense, and dividend accounts to zero and transfer the net income or loss to the owner's equity account. The accounting cycle is a continuous process that is repeated every accounting period to provide accurate financial information for decision-making purposes. It helps small business owners to understand their financial position, assess their performance, and make informed decisions about future operations. Now it's time to move on to the next lesson, where we'll go over a simple but absolutely crucial equation. This is not just the single most important equation in the subject, but actually, the foundation on which everything in accounting rests.